Are you scared to invest just because the market is down? That fear makes complete sense, and I'm not going to tell you not to feel it. But I do want to offer a different frame, one that I think is actually more grounded in how the markets work. When people see red numbers, the instinct is to wait. Wait until things look better, wait until it feels safer, and that instinct is human. It's not irrational. But here's what that instinct misses. When the market is down, you're essentially buying at lower prices. That's not a bad thing for someone who is years or even decades away from needing that money. It's actually the opposite. Think of it like this. If your grocery store puts everything on a 20% off sale, you wouldn't stop buying groceries. You'd probably buy a little more. The market isn't exactly the same thing. There are real risks, but the underlying logic of lower price, more potential upside later still applies when you're investing for the long run. A Roth IRA is specifically designed for long-term tax-free growth. The contributions you make during a down period have more room to grow when markets recover. And historically, markets have recovered. That's not a guarantee, but it is the long-term pattern. This doesn't mean that any market environment is automatically a good time to invest. Your personal situation matters. Your income stability, your timeline, your existing emergency cushion. Investing when you don't have a financial foundation under you is a different conversation. The fear is worth listening to. I just don't want it to be the only voice in the room. So if you're trying to figure out what makes sense to your specific situation, that's exactly the kind of conversation a financial planner is for. And if you're interested in more of this type of content, give us a follow.